Good afternoon. It is Monday, November 13th, 4:52 p.m. Markets are closed. Pretty quiet day today. First, I'd like to thank everybody for their comments on my previous video. Very insightful. It's nice to engage. Pretty quiet day. Dow was up slightly, S&P was up slightly, Nasdaq was up slightly, dollar was up a little. Gold hanging in there. It came back up about $3-4 at one point. Difficulty trying to get over that 1279 level right now, that 100-day moving average, after they whacked it down on Friday below that 100-day moving average. Right now it's at 1277, but it's well clear of the 200-day moving average, so it's looking okay. There's a 91.5% probability of a December rate hike, so I would say everything is priced in at this point. Everything is priced in for the dollar, and everything is priced in for gold. So it looks like all the headwinds are behind gold right now. Okay? I saw this little article here, peak dollar. Gold to benefit from peak dollar. Gold's chief rival, the U.S. dollar, is ripe to resume its downtrend, says one analyst who expects commodities to rally in 2018, particularly the yellow metal. Caged within the narrowing ranges the past few weeks, the dollar and its reciprocal gold appear ripe to break out, noted Mike McGlone, commodity strategist at Bloomberg Intelligence, in a report Monday. The path of least resistance is likely the 2017 trend. Dollar down, gold up. Gold prices have rebounded Monday, while the U.S. dollar also continues to climb. The two assets remain range-bound as markets gear up for the Federal Reserve's December meeting, where investors are pricing in a 91.5% chance the central bank will raise rates. A potential peak dollar should be a game changer for markets favoring commodities. Despite the rate hike cycle, the best days for the U.S. trade-weighted dollar appear behind, he wrote. So I say, and I said it before, bring it on already. Bring on this December rate hike. Let's get it behind us. It's already priced in. Bring it on, okay? Based on history, based on what's happened just recently, 2015, 2016, rising rates are not negative for gold. So I say bring it on. A couple of things I wanted to talk about. I saw this headline on Zero Hedge, Chipotle tumbles. Somebody got sick, and let me see if I can find it real fast. It was earlier today. Chipotle tumbles. As Chipotle tumbles. Supergirl actor says he almost died after eating a burrito chain. So I went and I looked at Chipotle, and it was down about 1%. 1%. Where's the tumble? See, this is the garbage you're going to get on a lot of these places. Okay? This fear porn. Okay? And these carnival barkers. It's very hard to be negative if that's going to be your shtick, if that's going to be your cash cow, and you got to be negative, okay, with these clickbait, okay. Chipotle ended up down 1.95 points, 0.7%, 0.7%. Is that a tumble? I'm done. I'm not even going to bother to look at Zero Hedge anymore. Okay, because it's just a lot of noise, it's a lot of distraction, and it just has to be fear porn and negative and just clickbait. Okay? So I don't even bother anymore. I'm not even going to bother. All right? It's just confusion. It's just confusion. I wanted to talk today about the bond vigilantes. You remember the bond vigilantes? A bond vigilante is a bond market investor who protests monetary or fiscal policies he considers inflationary by selling bonds, thus increasing yields. Are the bond vigilantes back? They've been sleeping for years. Are they back? This is starting to make some noise, the bond vigilantes. In the bond market, prices move inversely to yields. When investors perceive that inflation risk or credit risk is rising, they demand higher yields to compensate for the added risk. It makes sense. It makes sense. So are all these policies ultimately inflationary? Huh? A bond market vigilante is somebody who protests monetary or fiscal policy. I'm protesting monetary and fiscal policies, as I'm sure most of you are. So are the bond vigilantes, after hibernating for all these years, are they finally starting to kind of stretch and kind of wake up? We got to watch this, people. Okay, very important to keep our eyes on this, the bond vigilantes, okay? The Trump administration's tax plan and its disregard for the effect it would have on the federal budget deficit is certain to pique the interest of a long dormant segment of bond investors. You know, he's just going to spend. That's what he does. That's how he's always done it. Spend, right? Borrow cheap, build casinos, earn money, right? Pay back, I guess. That's his plan, right? If Donald Trump plans on enacting his aggressive domestic spending agenda, there's one tough group he'll have to get through first, and it's not Democrats or Republicans. The so-called bond vigilantes, who have been missing from the market for the better part of a generation, could be making a return appearance soon. They last stepped in to make former President Bill Clinton tone down his spending agenda in the early 1990s. And they look to be making a return appearance as the new chief executive gets set to implement aggressive fiscal programs. Very interesting article. But basically, you know what? The Fed can only tweak, they can only calibrate, they can only pick winners and losers so long. Eventually, what's left of the free market will assert itself. Okay? Well, we've now got fiscal policy again and in spades, suggesting that bond investors are once again important. More, the prospect of higher interest rates and inflation could even herald the return of the bond vigilantes. So we have to watch this, okay? Take a look at this chart, people, if you can see that. Gold bug squished. It made its high during that debt ceiling crisis, right? It's been in this long range for a very long time. Look how important that is. Why do you think they took it down the other day? Look at that 5-year average. There's the battle, people, right there. That 200-day moving average is 1263, which we're above. The 100-day is 1279. We got to try to take that back. If we get past that line, and I'm calling 1340, that's when I'll flip to a bull, okay? That's the first chart I want to show you. The next chart I want to show you, look at this chart. Flat world. Can you see that? That's the yield curve. That's the spread. We talked about that. The spread between 2s and 30 is blue. It's narrowing and narrowing. The spread between 5s and 30s, narrowing and narrowing. It's going flat, right? That's a sign of a recession. A flat yield curve. They'll try to tell you, oh, it don't matter. It's okay. No, it matters. So don't let them fool you. And this is debt. That's debt. That's the projected debt. It only goes one way, the debt burden. This is what the bond vigilantes are going to look at. This is what they're looking at. When are they going to step in and wake up? It could be soon, people. That's the debt burden. They'll need to sell more and more bonds. Okay? People are going to demand higher return on those bonds. Okay? As the credit risk and the market risk increases. So I think we're near an inflection point. I really do. I like the action in gold, relatively speaking. Okay, it's been a disaster. I've made that clear. If I had to give it a grade, I give it an F. Okay, but short term, I like its resiliency. I'm watching very closely. I'm looking at this 1280 level very closely. Okay, so that's pretty much it for today. Let's keep our eyes on these bonds. Let's see if the bond vigilantes finally start to wake up. That's it, people. Have a good day. Ciao.